When a business makes a sale, that's fantastic. But really, the job isn't done until the cash is actually in the bank. That little gap, the space between making the sale and getting paid, that's where one of the most critical assets on a company's books lives: receivables. So let's get into it and see exactly how companies report on and analyze these promises of future cash.
And just before we dive in, a quick heads up that the material for this explainer was prepared by Dr. Samir Al-Rishani with some AI support.
All right, here's our game plan. We're going to start with the basics. What even are receivables? Then we'll get into the tricky part. What happens when people don't pay? We'll introduce a more formal type of receivable, see how this all looks on the official financial statements, and finally wrap up with how companies actually manage this super important asset.
Okay, first things first. When we throw around the word receivables, what are we really talking about? At its core, it's pretty simple. Receivables are just the amounts owed to a company. They're basically IOs from customers. Now, you'll mainly see two flavors of this: accounts receivable, which is your standard everyday credit you give on a sale, and notes receivable, which is a bit more formal, and we'll definitely get into that a little later. Let's walk through a classic example to make this real. Imagine Jordache Corp makes a $1,000 sale, but on credit. A few days later, the customer sends a little bit of it back. Then, near the end of the month, boom, Jordache gets paid. I mean, this little three-step dance, it's happening millions of times a day in businesses all over the world. So how on earth does a company keep all this straight for every single customer? Well, that's what we're looking at here. This is a subsidiary ledger. Think of it like a mini statement just for one customer, Polo Limited. You can see it all play out. The initial sale pops the balance up to $1,000, the $75 return knocks it down a bit, and finally, the payment brings it right back to zero. This level of detail is absolutely essential for managing who owes you what. Now, offering credit is a fantastic way to encourage sales, no doubt, but it comes with a built-in risk. And that brings us to, well, one of the unavoidable truths of doing business. What happens when that promise of future cash gets broken? When a customer, for whatever reason, just doesn't pay? Smart businesses don't just sit around and wait for this to happen. They actually plan for it, using something called the allowance method. The really clever part about this method is that it perfectly matches the expense of a bad debt with the period when the original sale was made. And they do this by setting up a special contra asset account. Just think of a contra asset as a negative account that's paired up with an asset. It basically works against the main accounts receivable account to show a much more realistic picture of what they expect to collect. So how do they come up with that estimate? Well, this table shows the process perfectly. It's called an aging schedule. The company basically sorts all of its receivables based on how old they are. And notice the logic here. It's pretty intuitive. The older a debt gets, the higher the chance it won't get paid. So a brand new receivable, maybe a 2% risk. But one that's over 60 days late, yikes, that jumps to a 40% risk. You add it all up, and Abrams Furniture figures it probably won't collect about $11,000. And here's how that estimate actually gets recorded in the accounting system. The aging schedule told us that the allowance account should have an $11,000 balance. So if it already has $1,000 in it from last time, they only need to add another $10,000 to get it to the right level. And that $10,000 adjustment, that becomes the credit losses expense for this period. Okay, let's pivot a little. We've been talking about the informal world of accounts receivable. Now let's level up to a related concept that has a lot more legal muscle behind it: notes receivable. This table just lays out the differences so clearly. While an accounts receivable is kind of an informal, we'll send you the bill, a note receivable is a formal, signed contract, a promissory note. And because it's so formal, you usually see two big things you don't get with regular AR: an interest payment and a longer time to pay, usually more than 30 days. And speaking of that interest, calculating it is super straightforward. You just take the main amount of the note, the principal, multiply it by the annual interest rate, and then multiply by the time period, making sure to express it as part of a year. So for a 6-month note, your time would just be 6 divided by 12, or 1/2. Simple as that. So a note receivable really only has two possible endings. It's either honored, which is the good one, it means it gets paid in full, on time, or it's dishonored, meaning the customer defaults. Now, if a note is dishonored, but the company still thinks they have a shot at getting the money, they'll move that balance out of notes receivable and put it back into accounts receivable to keep trying to collect. Okay, so we've been busy recording all these transactions behind the scenes. How does a company take all this information and package it up for investors, for banks, for everyone to see? Here's a little snapshot right from the balance sheet, and this is so important. Notice the company doesn't just say, hey, we're owed $200,000. No, it shows the full gross amount, but then it immediately subtracts that $11,000 allowance for bad debts. The final number, that $189,000, that's called the carrying amount. It's the company's most honest, most realistic guess of the cash it's actually going to collect. It's all about transparency. And what about the income statement? Well, those credit losses we talked about, they show up as a normal operating expense. It's just part of the cost of doing business on credit. But any interest the company earns from those notes receivable, that's usually reported separately under other income, since it's not really part of the company's main day-to-day business. Okay, this brings us to our final and maybe most important section. Accounting isn't just about looking backward. It's about giving managers the tools they need to run the business better right now. So how do they use all this data? One of the most powerful tools in the toolbox is the receivables turnover ratio. This little number tells you how efficiently and how quickly a company is collecting on its sales. A higher number is what you want to see. It means the company is turning those IOUs back into cold, hard cash more often during the year. Let's look at a real-world example here with NFI Group. They had over $2 billion in credit sales. Now, to calculate their turnover, we divide that by their average accounts receivable for the year. And to get that average, we just add the balance from the end of 2020 to the end of 2021 and divide by 2. That gives us an average of about $355,000. And when you do the math, that $2 billion in sales divided by our average receivable, you get 5.8 times. So what does that mean? It means that during 2021, NFI Group basically collected its entire average receivables balance almost 6 times over. Now, a number like this is most powerful when you compare it to last year, or even better, to other companies in the same industry. It tells you if you're collecting faster or slower than the competition. Now, 5.8 times is a little abstract, right? So here's a way to make it much more concrete. The average collection period. It turns that ratio into something we can all understand. Days. For NFI Group, we take 365 days and divide by our turnover of 5.8. That gives us about 63 days. That means, on average, it takes NFI Group 2 months to get paid after they make a sale. And for this metric, a lower number is definitely better. You want that cash in the door as fast as possible. So in the end, it all comes back to this simple idea. A company's receivables are really just a big list of promises. But the real question is, how well is that company managing those promises? The answer you get from digging into these numbers, well, it reveals a lot more than just accounting. It tells you about the fundamental health and efficiency of the entire business.